Ladies and gentlemen, turn off every distraction. Close every browser tab. Because what I'm about to reveal will completely change how you understand what's happening in the silver market right now. This is not speculation. This is not theory. This is documented action taken by one of the largest economies on Earth. Action that exposes a crisis so severe that regulators had no choice but to intervene with emergency measures. And if you don't understand what this intervention actually means, you're about to misread the most important signal the precious metals market has given us in over a decade. Right now, silver is trading at $85.15 per ounce. Gold is sitting at $4,918. And I need you to understand something critical before we go any further. These prices are not the ceiling. They're not even close to fair value. They're the battlefield where control is being fought over in real time. Because while you were watching charts and checking your portfolio, something unprecedented just occurred. The Chinese government, without warning and without apology, shut down 5 separate commodity funds in a single trading session. Not for minutes, not for a cooling off period. Complete trading suspension. The only silver futures fund available to mainland Chinese investors locked for an entire day. 4 oil-focused funds frozen simultaneously until further notice. This wasn't maintenance, this wasn't a technical issue. This was an emergency response to what regulators openly described as systemic risk and imminent massive investor losses. And here's what makes this moment different from every other time regulators have stepped in. This is the second emergency shutdown in 8 days. Whatever they thought they fixed on January 22nd clearly didn't work. The problem came roaring back with enough force that they had no choice but to slam the brakes again. When the second largest economy on the planet starts implementing emergency trading halts because commodity demand has spiraled beyond their control, you don't get to dismiss it as regulatory overreach. You don't get to call it China being China. Because what's happening in their markets is a direct reflection of pressure building everywhere. And that pressure is about to find new outlets. I'm here to show you exactly what those outlets are. And more importantly, how to position yourself before the next phase detonates. Now, before we dissect what this means for your wealth, I need you to do something for me. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to see it. And subscribe if you haven't already, because what's coming in February is going to separate the prepared from the blindsided. Let me walk you through exactly what happened, because the specifics reveal everything. On January 30th, Chinese financial authorities executed what can only be described as coordinated emergency suspensions across multiple commodity investment vehicles. The most significant target was the UBS SDIC Silver Futures Fund. This is not some obscure regional product. This is the only public fund in all of mainland China that directly invests in silver futures. The only one. When 1.4 billion people have exactly one regulated option for silver futures exposure, and that option gets shut down for an entire trading day, you're not watching routine market management. You're watching panic containment. But it gets worse. At the exact same moment, 4 separate oil-focused listed open-ended funds got hit with synchronized suspensions, each one frozen until 10:30 a.m. Beijing time. The coordination is the signal. When regulators move on multiple funds simultaneously across different commodities, they're not responding to isolated problems. They're responding to systemic breakdown. So what broke? What forced their hand? The answer is premiums. Specifically, the gap between what investors were paying for fund shares versus what the underlying assets were actually worth. And the numbers are absolutely insane. The UBS SDIC Silver Futures Fund was trading at a 36% premium to net asset value. And let me say that again so you understand the magnitude. Investors were paying 36% more than the actual silver futures were worth just to get exposure through this fund. Think about what that means in practical terms. If you bought shares at that premium and the underlying silver futures stayed completely flat, you would be sitting on an immediate 36% loss the moment that premium normalized. You weren't buying silver. You were buying desperation. You were buying the fear of missing out at any price. Chinese retail investors were so desperate to get silver exposure that they were willing to pay more than a third extra just to get in the door. They weren't asking what the metal was worth. They were asking how fast they could get positioned before it ran away from them. And regulators saw exactly where that behavior was heading. They saw retail money piling in at mathematically unsustainable prices. They saw the feedback loop building. The higher the premium went, the more momentum chasers interpreted it as confirmation that silver was the hottest trade on the planet. So they piled in harder, which pushed the premium higher, which attracted more momentum chasers. This is the death spiral that regulators decided to stop before it consumed the entire retail investor base. Not because they're anti-precious metals, not because they want to suppress prices, but because they understood that when that premium inevitably collapsed, the losses would be catastrophic for millions of people who had no idea what they were actually buying. Now, here's the question nobody in the financial media is asking. Why was demand so extreme in the first place? Why were Chinese investors willing to pay 36% premiums when they could have just waited? The answer reveals everything about where we are in this cycle. Silver has been on an absolute tear. In the last 30 days alone, silver has surged 58%, not 5%, not 15%, 58%. We're talking about prices that pushed toward $118.58 per ounce at the peak, levels that would have seemed delusional just 6 months ago. Gold has been running equally hot, up 22% and approaching $5,600 per ounce. Oil has broken through resistance, with Brent crude hitting 5-month highs above $70 per barrel. This is not random price action. This is not sector rotation. This is a coordinated flight into hard assets driven by forces that are accelerating, not slowing down. First, there's the monetary policy chaos. Central banks have been whipsawing between aggressive cut expectations and higher for longer rhetoric. Every time traders price in easier money, the dollar weakens, real yields compress, and precious metals catch a bid. Every time hawkish comments return, we get violent pullbacks. This back and forth has created extreme volatility. And that volatility gets amplified through leveraged instruments like the funds China just suspended. Second, there's the geopolitical overlay. U.S. naval positioning near Iranian waters, escalating tensions across multiple theaters, energy supply chains looking vulnerable. And when traders start pricing conflict risk into oil, and when investors start hedging currency debasement through precious metals, you get the kind of demand surge that overwhelms normal market infrastructure. Third, there's the structural supply crisis that almost nobody is connecting to current prices. Silver is not just a monetary metal. It's an industrial workhorse. Solar panels consume silver. Electric vehicles consume silver. 5G infrastructure consumes silver. The green energy transition that every major government has committed to is fundamentally silver intensive, and supply has not kept pace with this structural demand growth. When you combine monetary demand, safe haven demand, and industrial demand all hitting simultaneously, you don't get orderly price discovery. You get the kind of violent moves we've been witnessing. And when that demand gets funneled through a single investment vehicle serving 1.4 billion people, you get 36% premiums and emergency trading halts. Now, I want to show you something that proves this is not isolated to China. Because what happened in Beijing is a symptom of pressure building everywhere. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed to its lowest level since 2011. That compression is not happening because gold is falling. It's happening because silver is playing catch-up in a dramatic way that historically signals major regime change. At the same time, physical silver demand has been exploding globally. One major dealer reported a 158% increase in sales of 1 ounce silver coins in less than 4 months, a 550% increase in demand for 1 kilogram silver bars over the same period. Google searches for how to buy silver and buy silver online have spiked 250% in recent months. This is not niche interest. This is mass awakening. People are looking for ways to get precious metals exposure outside the traditional financial system, and physical accumulation is one of the clearest expressions of that impulse. So when Chinese regulators shut down their only silver futures fund, that demand doesn't disappear. It redirects. Some of it flows into physical silver, some of it flows into Hong Kong listed products, some of it flows into gold as an alternative, and some of it creates pressure on international markets as capital finds other pathways. This is the critical point that everyone is missing. The trading halt didn't kill demand, it just forced that demand to find new routes. And every new route it finds creates additional pressure on global supply chains that are already stretched to the breaking point. Let me show you the smoking gun that proves this entire thesis. Usually, when a market crashes or gets halted, it triggers a feeding frenzy on the short side. Hedge funds smell blood, algorithms pile in, they borrow shares and try to ride the price down. And when that happens, the cost to borrow shares skyrockets because everyone is fighting for the same inventory. But right now, the borrow fee for SLV, the largest silver ETF in the world, is sitting at basically zero, rock bottom. And there are millions of shares available to borrow just sitting there collecting dust. Nobody wants them. Nobody is shorting. Do you understand how insane that is? China just implemented emergency trading halts. The narrative should be that the silver rally is over, that regulators are clamping down, that the trade is crowded and vulnerable. And yet the smart money is refusing to bet against it. Why? Because hedge fund managers are not stupid. They're looking at the same data we just looked at. They see the 58% move in 30 days. They see the physical demand explosion. They see the structural supply deficit. They see Chinese demand getting redirected into other markets. And they know that shorting silver right now is like standing in front of a freight train, holding up a piece of paper that says, "Stop." The freight train is global demand for hard assets. And if you stand in front of it, You don't get rich, you get obliterated. This tells us exactly who is responsible for any price weakness we're seeing. It's not the market, it's not institutional selling. It's a small handful of bullion banks dumping contracts to keep the price contained. They're naked shorting positions they don't have because they're desperate to cap the price and protect dollar credibility. But they're alone. The rest of the financial world is standing on the sidelines, refusing to join them, because the smart money knows this $85 price is not a ceiling, it's a coiled spring. And the moment the suppression stops, the arbitrage will wake up and the price will gap violently higher. Now, I need to talk about the oil side of this story, because it's connected to silver in ways that most people are completely missing. Remember, China didn't just suspend the Silver Futures Fund. They hit 4 separate oil-focused funds at exactly the same time. That coordination is the tell. And when regulators move simultaneously across different commodity sectors, they're seeing the same pattern playing out everywhere. And here's what that pattern looks like. Brent crude broke above $70 per barrel for the first time in 5 months, on the exact day these suspensions happened. That breakout coincided with U.S. naval vessels positioning near Iranian waters. The market was pricing geopolitical risk premium directly into energy prices. And Chinese investors were chasing that trade through oil-focused funds with the exact same momentum behavior they showed in silver. Let me show you the feedback loop that regulators were trying to break. When geopolitical tensions rise, commodity prices rise. When commodity prices rise, retail investors chase. When retail investors chase through concentrated fund structures, premiums expand. When premiums expand beyond sustainable levels, regulators intervene. But here's the critical part that everyone is missing. The intervention treats the symptom, not the cause. The geopolitical tensions are still there. The supply vulnerabilities are still there. The demand is still there. Suspending trading for an hour doesn't make those forces disappear. It just compresses them temporarily. This is why I believe the oil story is far from over. And more importantly, it's why the oil story validates everything we're seeing in precious metals. Because they're both being driven by the same underlying force. Loss of confidence in paper systems and flight into physical assets. Think about what oil and silver have in common. They're both strategic commodities. They're both essential to modern infrastructure. They're both vulnerable to supply disruptions. And they're both traded in markets where paper contracts massively outnumber physical delivery capacity. When those markets come under stress, when demand surges faster than supply can respond, when geopolitical risk makes future availability uncertain, investors start questioning whether their paper exposure will actually convert to physical delivery when it matters. That's when premiums explode. That's when funds start trading at 36% above net asset value. That's when regulators panic and shut everything down. But shutting down trading doesn't create more oil. It doesn't create more silver. It just hides the supply crisis temporarily behind regulatory curtains. And here's what happens next. The pressure builds. The demand finds alternative routes. The premiums show up in different markets: Hong Kong, Singapore, London. Wherever Chinese capital can flow without restriction. This is already happening. We're seeing it in the physical silver premium data. We're seeing it in the compressed gold-silver ratio. We're seeing it in the refusal of institutional money to short despite apparent vulnerability. The smart money understands what regulators don't want to admit. You can suspend trading. You can implement cooling-off periods. You can restrict new fund purchases. But you cannot suspend the fundamental forces driving demand. And you cannot manufacture physical supply with regulatory decree. So when I look at China's intervention, I don't see the end of the commodity rally. I see confirmation that the rally has gotten strong enough to threaten systemic stability. And that tells me we're nowhere near the top. Because if we were near the top, regulators wouldn't need to intervene. Weak hands would be selling naturally. Premiums would be compressing on their own. The market would be finding equilibrium without emergency measures. The fact that they had to shut down trading twice in 8 days tells you the opposite. It tells you that demand is so relentless, so overwhelming, that normal market mechanisms can't handle it. And when normal mechanisms can't handle demand, that demand doesn't disappear. It just gets more creative about finding outlets. Now let me address the elephant in the room, because I know some of you are thinking it. Yes, silver has momentum. Yes, the fundamentals look supportive. Yes, China's trading halt reveals genuine demand pressure. But markets that run this hard, this fast, are also prone to sharp corrections. The same volatility that creates 58% gains in a month can create 30% drawdowns in a week. Some analysts have projected silver reaching $150 within 3 months. That's a bold call. And it might be right. But it's also the kind of projection that tends to appear near cycle tops rather than bottoms. When major institutions start publishing aggressive upside targets, it's often a sign that retail enthusiasm is peaking. I'm not saying sell everything. I'm not saying the rally is over. I'm saying be aware of where we are. The easy money has been made. The obvious trade has been executed. What comes next requires more nuance, more patience, and more discipline. If you're already positioned in silver, this is probably a time to think about risk management rather than adding at extended prices. If you're not yet positioned, this is probably a time to wait for pullbacks rather than chasing momentum at 52-week highs. The people who build real wealth in these markets are the ones who buy fear and sell greed. Right now, there's a lot of greed in the silver market. That doesn't mean the bull run is over. It means the next phase will require more skill than the first phase. But here's what I want you to understand about China's intervention. This is not the end of the story. This is the beginning of a pattern. When commodity markets get hot enough to threaten systemic stability, regulators will intervene. They'll suspend trading. They'll restrict new purchases. They'll implement cooling off periods. They'll do whatever they think is necessary to prevent retail investors from destroying themselves. That doesn't mean the underlying trend is wrong. It means the trend is strong enough to scare authorities. And when trends get that strong, they tend to have more room to run once the intervention pressure eases. The historical precedent is clear. Every major precious metals bull market has featured regulatory interventions along the way. The 1970s bull run in gold had multiple moments where authorities tried to cool the market. The 2000s run featured similar dynamics. Each time, the interventions created temporary pauses, but didn't reverse the fundamental forces driving prices higher. I'm not saying history will repeat exactly. I'm saying the pattern of intervention during strong bull markets is normal, not exceptional. If you're using China's trading halt as a reason to panic out of positions, you might be misreading the signal entirely. Let me give you a framework for thinking about what comes next, because frameworks are more useful than predictions. First, recognize that China's trading halt is a signal, not an endpoint. It tells you that demand for commodity exposure has exceeded the infrastructure's capacity to handle it smoothly. That kind of demand doesn't disappear when you suspend trading. It redirects, it builds pressure, and eventually that pressure gets released. Second, understand that premiums and discounts in fund structures are information. When a fund trades at a 36% premium, the market is screaming something about desperation levels and supply constraints. That information is valuable even if you never trade that specific fund. Third, differentiate between trading and accumulating. If you're trading short term, this is an environment that rewards patience and punishes chasing. Wait for pullbacks. Don't pay premium prices for exposure you can get cheaper next week. If you're accumulating long-term, short-term volatility matters less. You're buying the decade-long thesis about currency debasement, industrial demand, and hard asset repricing. In that framework, temporary suspensions in Chinese funds are noise, not signal. Fourth, pay attention to the physical market. When fund trading gets disrupted, physical metal becomes more attractive. The premiums dealers charge for physical silver and gold or information. When those premiums expand, it tells you the physical market is tightening. When they compress, it tells you supply is catching up with demand. And right now, the physical market is screaming. Let me show you the data that nobody is connecting. Major dealers are reporting unprecedented demand patterns. 158% increase in 1 ounce silver coin sales in less than 4 months. 550% surge in 1 kilogram bar purchases over the same period. These aren't marginal increases. These are panic buying levels. But here's what makes this data even more significant. This physical demand explosion is happening simultaneously with China's fund suspensions. Think about what that means. Chinese investors can't get futures exposure through their preferred fund. So where is that capital going? Part of it is flowing into physical metal. Part of it is finding alternative paper vehicles. But the physical component is real and measurable. When you shut down paper access in the world's second largest economy, you don't kill demand. You redirect it into channels that are even harder to suppress. Physical metal doesn't have trading halts. Physical metal doesn't have fund managers who can block purchases. Physical metal is the ultimate escape hatch from financial system control. This is why I keep emphasizing the importance of watching at dealer premiums. When premiums on physical metal start expanding significantly above spot prices, it's telling you that the paper price is disconnected from physical reality. It's telling you that people are willing to pay more than the official quote just to secure actual possession. And we're starting to see those premiums tick up in certain markets. Not everywhere yet, not uniform across all products, but the trend is forming. And if Chinese demand continues redirecting into physical channels, those premiums will expand further. This creates a self-reinforcing dynamic that regulators cannot stop. The more they restrict paper trading, the more demand flows into physical. The more demand flows into physical, the tighter the physical supply becomes. The tighter physical supply becomes, the wider premiums expand. And wider premiums validate the thesis that paper prices are artificial and physical possession is what matters. You cannot regulate your way out of a supply crisis. You cannot suspend your way out of fundamental demand. And you cannot wish away the consequences of decades of underinvestment in mining capacity while industrial consumption accelerates. China's intervention is trying to manage symptoms while ignoring causes. And that approach has never worked in commodity markets. Not in oil, not in copper, not in agricultural products, and it won't work in silver. Fifth, watch the gold-silver ratio closely. This metric has been one of the most reliable signals in the precious metals complex for decades. When it reaches extremes and starts to mean revert, the moves can be powerful. We're in one of those reversion phases right now. Whether it continues or reverses will tell you a lot about where we are in the cycle. Now let me talk about what I think is actually happening beneath all of this volatility. What we're watching right now is a stress test of global commodity market infrastructure. The combination of geopolitical uncertainty, monetary policy confusion, and structural demand growth is pushing markets in ways they weren't designed to handle. China's response of suspending trading is one approach. Other jurisdictions may respond differently. But the underlying pressure is the same everywhere, and that pressure tends to produce something very specific over time. It produces repricing, it produces revaluation, it produces a fundamental shift in how people think about what's valuable and what's risky. Paper assets that seemed safe start to feel fragile. Hard assets that seemed old-fashioned start to feel essential. Fiat currencies that seemed stable start to feel experimental. Physical commodities that seemed boring start to feel strategic. That's not a prediction about next week or next month. That's an observation about where we are in a multi-decade cycle. The people who recognize these cycle shifts early are the ones who position themselves for generational wealth transfer. The people who dismiss them as noise are the ones who get left behind holding devalued paper. Here's my question for you, and I want to see this discussion in the comments. Do you think China's trading halt is a warning sign that the silver rally has gone too far? Or do you think it is confirmation that demand is so strong that even regulators can't contain it? There's no wrong answer. But your answer reveals how you're interpreting this moment, and that interpretation will shape your positioning going forward. Drop your thoughts below. And if you've been navigating this precious metals rally successfully, share what's worked for you. Real-world feedback from this community is valuable for everyone watching. Let me leave you with one final thought that captures where we are. When authorities intervene in markets, they're telling you something important. They're telling you that the market has gotten strong enough to scare them. And when markets scare authorities, it's usually because something fundamental has shifted. The structural forces driving precious metals demand are not going away. Currency debasement concerns are not going away. Geopolitical uncertainty is not going away. Industrial demand for silver and green technologies is not going away. Central bank accumulation of gold is not going away. These are multi-year themes, not multi-week trades. And if you're positioned for the multi-year story, the day-to-day noise of regulatory interventions and volatility spikes becomes much easier to navigate. Let me give you one more framework for thinking about this moment, because I think it captures something essential that's easy to miss in all the chaos. Markets move in cycles: bull markets, bear markets, consolidation phases, breakout phases. And within those larger cycles, there are smaller patterns. Regulatory intervention is one of those patterns, and it tends to happen at specific points in the cycle. Early in a bull market, when prices are just starting to move, regulators don't care. The moves are small, retail participation is limited, there's no systemic concern. But as the bull market matures, as prices accelerate, as retail enthusiasm builds, as leverage enters the system, regulators start paying attention. They see the premiums expanding, they see the momentum chasing, they see the leverage ratios climbing, and they make a judgment call. Do we let this run and risk a catastrophic bust? Or do we intervene now to contain the damage? China chose intervention. They saw 36% premiums and said, this has gone too far. We need to protect retail investors from themselves. That decision tells us something critical about where we are in this cycle. We're not early. The easy money has been made, but we're not late either. If we were late, if we were near the top, premiums would be compressing naturally. Weak hands would be selling into strength. The smart money would be heading for the exits. That's not what's happening. The smart money is refusing to short. Physical demand is accelerating. The gold-silver ratio is telling us silver has more room to run relative to gold. And Chinese demand, despite being blocked from their preferred channel, is finding alternative outlets. This is the middle phase of a major bull market, the phase where volatility increases, where regulatory attention intensifies, where weak hands get shaken out, but where the underlying trend remains intact and powerful. The people who build generational wealth are the ones who can navigate this middle phase without panicking, the ones who can separate noise from signal, the ones who understand that intervention doesn't mean invalidation. China's trading halt is not telling you to sell. It's telling you that demand has gotten strong enough to scare regulators. And when demand scares regulators during a bull market, history suggests you pay attention to what that demand is telling you, not what the intervention is trying to suppress. Don't confuse intervention with defeat. Don't confuse temporary suspensions with trend reversal. And don't let short-term noise steal your conviction when the long-term thesis remains intact. This is The Asian Guy. It's Friday, January 30th, 2026. Silver is at $85.15. Gold is at $4,918. China just shut down their only silver futures fund for the second time in 8 days. Physical demand is exploding globally. The gold-silver ratio is at levels we haven't seen since 2011. And the smart money is refusing to short despite all the apparent chaos. If this breakdown helped you see through the noise and understand what's actually happening, remember to like the video, subscribe to the channel, and share this with someone who needs to hear it. Stay sharp. Don't let intervention noise shake your conviction, and I'll see you in the next one.